Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at another requested stock. And this stock is Immersion Corp, ticker IMMR. And I'm torn on this one because their revenues are not looking too good, and we'll see that when we get into the numbers. But the field that they're in and some of the other metrics, not too shabby. So we can start with the profile because I knew nothing about them. But they basically deal in mobility and gaming in the virtual and augmented reality space with wearables and in the industrial internet of things. So they're basically a tech company that if things do trend towards virtual reality and augmented reality as they look like they're going, might have some potential here in the future. We'd have to dig down deeper into where their actual revenues are coming from and where they might experience growth. That'll be another video. If you guys are interested in it, drop a like, subscribe so that you can see that when it comes out. But for today, we are looking at where it stands today fundamentally. And that is all graphed out here. So this stock is a very technical stock. It has a lot of lines of support and resistance that it just keeps coming back to. And these are all the blues down here. This green is our margin of safety because we're saying that the fair value is somewhere just north of $15. So we'd be looking at, as value investors, to be getting in $12.50 and below. And then we'd want to reevaluate our position once it gets above $17. So that's basically the peak that it's ever been at, is up there at the overvalued portion. So the market kind of seems to agree with these numbers as well. And it keeps coming up and touching the fair value here. It's touched it 3 times. And it's kind of fluctuated a bit around the fair value when it gets there. Right now, sitting right about $7.30 per share. It's gone as low as the $4 range pretty recently, just last year. So clearly it's undervalued. But now the question is there enough growth potential to make it a worthwhile purchase? So this is where we see how quality the company is. Revenues are my biggest red flag here. They came in at 38.46 last year, 35.09 2021, 30.46 in 2020, 35.95 in 2019. So they are stuck in the low 30s. They peaked above in 2022. This year, they're only expected to come in just shy of 34. Next year, 30 is the expectation for them. So that's not a good revenue trend. There's not a whole lot of growth there that they're showing across this whole timeline. So unless they can show potential for revenue growth, it's definitely not a reasonable purchase, not a quality company. Now we can see if they're shaping other things up to make up for the lack of revenue growth, and clearly they are. Their expenses as a portion of revenue, they were blowing more money than they were making in 2019. A little bit better than break even in 2020, and now their year after year margins are improving. Right now, this last year they had 79.7% net margins, and that is really good. So it definitely has my interest peaked. The revenue, huge issue with it, but the fact that they're shaping everything else up and becoming a better operation, hopefully they can get their marketing in line, and then things should hopefully be off to the races. Because if we look at the graph here, revenue looks like it's on the decline. Definitely not something that we want. But their gross profit, net profit, and EBIT have been on a pretty good run. I mean, the gross profit dipped down's on its way back up. It's kind of in line with the revenue, of course. But then the net profit and EBIT have just been getting a little bit better year after year. So they're clearly shaping up their operations in a good way. Now they need to grow. Balance sheet is actually pretty good here as well. We see some nice asset growth, a bit of a dip in 2020, could be COVID related. We can dig into that deeper if it's a stock that we really think that is worth purchasing. And then the tangible assets, showing a very similar trend, but there is growth. Liabilities, very flat, kind of on the downtrend, and pretty dang low when you see 250 over here, $250 million over here on the assets, and then the peak over here is 160, and that's a tangible book value. Of the actual liabilities, it's 40 million. So they have a pretty good balance sheet as well. Cash flows, a little crazy. Kind of showing the trend as everything else. Of course, we're trying to fill in averages over here because we do want a consistent cash flow from the company. So these two positives outweigh those negatives and end up with something along these lines. If the revenues are decreasing and they're coming in with the same percentage cash flow yield, then this is going to be a declining number. So that's why we really want to see those revenues going before we buy in. Dividends, they've never really paid dividends up until recently. They started paying a special dividend this year. We'll see if it continues into the future. Hopefully they do. As we know here on the channel, I personally don't like to purchase stocks that don't pay a dividend, but that doesn't mean that it's a hard rule. And then everything graphed here, the valuations tend to be pretty close. We see that everything is in line here tightly between 10 and 20. Like I said, around the $15 level would be fair value. So we'd be looking at this line going up to here. And that's really it for this. The dividend line looks so incredibly high because they just started paying a dividend. So over time, if that's something they continue to pay, that will be fixed. But right now, it does look exorbitant. But we can go back to the metrics. We are running through all of the orange here. So they do have really good growth in their earnings. Earnings per share, 92 cents last year. They're expected to do 128 this year, 135 next year. Great. Earnings yield, 17.4%. Very good. Their share count, they are all over the place. They bought back shares, it looks, in 2019, and then they started issuing them again in 2021 or in 2020, and have not stopped issuing them. So that is a red flag there. We don't like a growing share count. We want to see a declining share count. Free cash flow yield, they came in at 104% this last year. So, of course, they're not going to come in with something like that. That's definitely accounting trickery there. But expectations for this year, we're hoping to see 14%, a tenth of what they had this last year. But still, 14% would be a good value here. And with the margins that they have, should be attainable. Assets, as we looked at the graph, are growing very nicely. They do have a nice tangible book value that is growing. Debt to equity is very low with that very low debt. And ROE, we're wanting 20. They came in just shy of 20 this last year. So, again, we want to see the revenue on the rise. And that's the story to the stock here is once they can prove that they have revenue growth potential, I would be for it. Ideally, they'd stop issuing shares as well. Probably part of the fact that they're not able to increase their revenue, they're having to issue shares to get money from shareholders, and that's not a good long-term option. When we look down here at the valuations, we see most of the value last year came from the cash flows. I think typically it's coming from either the balance sheet or the earnings. Of course, they just started issuing the dividend, so that messes stuff up a little bit. But we're looking at last year's fair value 15, this year's fair value 14.69, and next year 15.5. And then we come down to our undervalued and overvalued metrics. We're looking at 13 for last year would be a good place to buy. 12.5 this year, 13 again next year. So really in the high 12s, below that, probably would not regret it. And then for overvalued, when we'd want to reevaluate the stock, $16 to $17, as we looked at on the chart at the start of the video. So this one, I mean, I don't want to say sell because they are very good at streamlining they're very good at streamlining their operations and improving metrics aside from revenue. So revenue growth is what we're on the lookout for here. I am going to say this is a hold, and I want to put it on a watch list, and I want to keep an eye on this because if they can start proving that they have the ability to grow their revenues, especially at these margins that they had last year, then I would be very interested in getting into it, especially with the way that things are going with the AR and VR. But that's what we're seeing for the stock. It gets a hold, and like I said at the start, like the video, let me know if this is a stock that you guys are interested in, that we want to dive deeper on. Subscribe if you want to keep following this stock or other stocks that we look at on this channel, and comment what other stocks we should be taking a look at, because I have a list that I'm working through on requests, and it's opening my eyes to some stocks that I wouldn't have looked at otherwise. So I want to thank you guys for watching, and I'll catch you next time.